Hi, I'm Lei Chiu. I'm the Portfolio Manager for International Technology Fund and Global Disruptors at AllianceBernstein. What has attracted me to become a technology portfolio manager is innovation and growth. Technology innovation is open-ended and constantly evolving. It is about the big ideas, and because it is secular, it does not get impacted as much by cyclical headwinds. Finding good technology investment is like finding the fine balance between art and science. You need to identify creative innovation in areas where adoption and growth rate are accelerating. But good investments are companies that come with financial discipline and strong business model and execution. What makes a successful innovation is not necessarily what makes a successful company. So it is a delicate balance that is challenging yet incredibly rewarding. There's so much worry in the market today. There's concern over the impact of war and geopolitical tension, and the inflationary impact from resource shortages. And the one that has negatively impacted tech the most is the effect of rising interest rates, both on economic growth and valuation. And as a result, we have experienced one of the biggest corrections in stock performance in the tech sector in recent years. But from the end demand perspective, we continue to see technology being quite resilient in a number of areas. In other words, technology provides defensive and durable growth above general market participants. Tech spend has been rising as a percent of GDP for years now because digitization and a database society is an irreversible trend. In addition, even with the end of the pandemic, the behavior change is set in motion continues its acceleration trend. In fact, the adoption for technology innovation to improve efficiency and flexibility will continue to rise, not decline, particularly in a supply-constrained inflationary environment. And this brings me to the next point. Tech spending has transcended old definitions of the sector. Technology innovation can be discovered across industries, and we continue to be excited about the outlooks of disruptive winners with enduring competitive advantages. It means more digitization, more automation and Internet of Things, more production innovation based on data analytics, and energy transformation to create ultimate energy independence. The superior way to invest in disruptive innovation is to identify across many industries where technology adoption is enabling efficiency and innovation. When investors think of high-growth companies, the immediate association is with hypergrowth and high valuation small to mid-cap names. While we have dedicated research to disruptive innovators at the early stage of the innovation S-curve, that does not mean we cannot construct a portfolio with balanced risk characteristics. True, there are some very interesting investment opportunities in areas such as cybersecurity, big data, and Internet of Things, where disruptive new entrants are growing at extraordinarily high growth rates. We'll never dismiss the new entrants that are game changers. But that does not preclude us from owning some of the large cap technology names. In fact, some of the most successful technology investments come from companies that leverage their existing competitive moat to grow into new areas. For instance, in the area of digital infrastructure as a service, the three largest players, Amazon's AWS, Microsoft's Azure, and Google's GCP together grew an impressive 41% off a revenue run rate of $140 billion. That was pretty incredible. And as the world continues to need more semiconductors and building up redundancies, from a manufacturing standpoint, we found compelling opportunities in leading semiconductor equipment manufacturers. They operate in an attractive oligopoly industry structure with visibility for multiple years ahead. Last word on the unicorns. They call unicorns because they're different. They offer a completely different business model, and they often don't conform to the way things historically have been run. But very successful investments can come from smaller technology companies. There's no such thing as a permanent small cap tech company. They either get disrupted away or they grow into their valuation. They're often serial self-disruptors. they continue to innovate and expand. ServiceNow, one of the leading cloud-based SaaS companies, was a $4 billion market cap in 2012, and today it is at $100 billion. During that period, NVIDIA went from an $8 billion market cap company to the $460 billion today. There's no steady and fast rule, but what we're looking for is the right market opportunity of the product and the quality of the management team with the ability to execute. The rising interest rates will pressure companies who derive a big portion of the valuation from their future growth. So rising discount rates have triggered a fairly significant correction in the valuation of the tech sector, because as a whole, tech companies are considered long-duration assets. However, there's also another side to this. A big part of rising rates is to combat inflation derived from resource constraints such as labor and raw materials. And since tech is deflationary, the demand for products such as automation, Internet of Things, and areas tied to energy transformation remain robust and can accelerate, in fact. In addition, I think the other regime change here, which is less talked about, is the fact that we are migrating away from a world where globalization enabled deflation across all goods and services. And with the geopolitical conflict and the supply chain and logistics weakness exposed by the pandemic, we will likely see more localization of production. That means there needs to be a greater role for technology to play here to help mitigate some of the redundancy costs. Since tech is deflationary and secular, in an environment with fear of rising inflation, tech could in fact offer downside protection, particularly in recently overcorrected sectors such as semiconductors and software. These areas will see strong and sustainable secular demand, and they will enjoy attractive industry structure which allows for more sustainable margin.
Hi, I'm Sammy Suzuki, Co-Chief Investment Officer of Strategic Core Equities at AllianceBernstein. Technology is indeed the largest sector within the MSCI World Index today. That's not surprising given the magnitude of innovation we've seen in our daily lives over the past few decades. What that also means is that there's a broad range of investable companies present within the tech sector. Some tech companies are bets on cash flows in the distant future, while others are companies that have already proven their ability to generate predictable and high free cash flows. Now, in addition to that, many of these tech companies proved to be quite defensive during the recent pandemic downturn, in part because these businesses, such as the cloud and enterprise software and e-commerce, are likely to grow over time, regardless of the economic cycle. Although in this particular downturn, the lack of human-to-human contact was also a contributing driver. But more importantly, over the long run, the beta and volatility in the tech sector have been on the decline for nearly 20 years. This is a function of increasing profit margins. The tech sector, including subsectors of semis and internet and software and services, have delivered the greatest improvement in profitability since the dot-com bubble. Structural growth and persistent cash flows, independent of the economic cycle, have been key. The structural advantage of these companies, which is derived from their high degree of intellectual property and long-term growth, should cause the tech sector to remain defensive and possibly become even more so in the future. Often, we own what we call tech enablers. These are companies that are critical to our lives, but frequently most consumers don't even know about them. We see a better balance of quality and valuation in these types of companies today. In our strategy, we buy companies with proven ability to generate high levels of free cash flows. Now, one advantage of these more established companies is the tremendous free cash flow that they generate. In the hands of the right management team, this cash flow can be reinvested profitably in their business or used for dividends or share buybacks. They can provide powerful and tangible benefits to investors in today's volatile environment. Tech companies generally have among the highest rates of free cash flow conversion out of any sector. One reason is that they are rich in intangible assets. Their assets are people and knowledge. That means that they are capital light. They don't have to spend so much money buying manufacturing facilities, for example. Additionally, these types of businesses typically enjoy high levels of differentiation, high switching costs, and network effects that give them a lot of pricing power. That's helpful in any environment, but it is particularly so in an inflationary one. Businesses that are capital light and have pricing power tend to generate high levels of free cash flows. In addition, our research indicates that the durability of these cash flows are sometimes overlooked by the market. In terms of valuation, the only metric in which the U.S. looks attractive is on free cash flow yield. This has been driven by the doubling of free cash flow margins since the global financial crisis. But remember that there are attractive technology companies outside of the U.S. too. Earnings growth is key. We love to build a portfolio of strong, profitable, and stable franchises at the right price. We don't believe in making dramatic portfolio changes based on macroeconomic projections alone. Having said that, between the yield curve inversion and declining PMIs, we do see risk of continued economic deceleration. We can find defensive companies in almost every sector. The more defensive names have been ignored by the market in the post-pandemic recovery. And we see compelling opportunities, including in the tech sector. Our objective is to balance quality, stability, and price. A key element here is in trading off quality and stability on the one hand versus price on the other hand. The level of opportunity with the right balance of Q, S, and P will dictate whether we change our exposure to the tech sector. Our investment philosophy is to focus on quality, stability, and price. I would also add that we have a whole generation of investors that grew up in an era where attention to price was generally not rewarded. A possible unwind of that construct is another risk that investors must consider. Balancing quality, stability, and price helps us deliver a smoother investment performance. Not having big drawdowns is key to long-term capital growth. We call this winning by not losing.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。